This is Bloomberg Intelligence.
The new tools that a metaverse can bring allows you to create more immersive content.
Companies are beginning to sell less oil, more electrons.
In-depth research and data on 2,000 companies and 130 industries.
The supply chain breakdown is combining with labor shortages.
Will Eastern manufacturers continue to dominate, or will there be a renewed interest in Western manufacturing?
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig into the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we look at upcoming trends in crypto. Plus, as mortgage rates rise, borrowers are looking for alternative financing to reduce purchase costs. But first, let's go into the crypto space, and I want to look at it from the perspective of the exchanges. So if you want to do that, you got to take a look at Coinbase. And if you want to look at Coinbase, you got to talk to Julie Shariel. She covers all things tech and fintech for Bloomberg Intelligence. Julie, tell us just kind of like, what is Coinbase and kind of how does it play in the fintech ecosystem?
Yeah, sure. So Coinbase is a crypto exchange. It is the largest one in the U.S., the second largest in the world, the only publicly traded crypto exchange that we have to deal with. So as a retail investor, if you want to buy or sell up to 90 or so different kinds of tokens, you go to Coinbase. If you're an institution, many of them increasingly go to Coinbase as well.
All right. So is this a way to play just all things crypto? And I don't want to necessarily make a bet on an individual token like Bitcoin or like Ethereum. I just want to have some exposure. Is this a good way for investors to do that?
It absolutely is. It hasn't been as good a performer this year as it has been last year in terms of a stock, right? So it does tend to trade very close to Bitcoin, very, very, very much in line. But this year we saw a bit of a divergence. So Bitcoin is off about 15% year to date. Coinbase shares are down 40%. So that's different from in the past where Coinbase has actually outperformed Bitcoin in particular.
Why do you think that happened?
So some concerns here that, one, we're going into a broader crypto winter, right? When we saw the sell-off in crypto, really starting back in the fourth quarter, there are concerns that this was going to be sort of a period where crypto just kept going down. We've had 3 crypto winters in the past. Could this be another one? If so, it's just a period of very, very light volume, very hard to make money. For Coinbase in particular, there are concerns about margin because it's growing, it's expanding, it's looking to broaden and diversify away from just crypto trading into more crypto services, into decentralized finance, which is the whole new area of financial services, into NFTs and all kinds of things that are being spun out of the crypto world. That investment is going to cost margin, but the margins are still pretty good, EBITDA around in the 20% range. So that's one reason, the main reasons why it's sold off a bit more than the underlying crypto asset.
Crypto winter. What is that? What do you think? Is that just endemic to this particular little piece of the market? People don't have really a good sense of the fundamentals of some of these crypto assets, and so interest waxes and wanes?
Yeah, I mean, Bitcoin has been around since 2009, right? So we've had since then 3 crypto winters, in this period of just really very light activity. Bitcoin in general, as many people who watch it will know, is very, very volatile. So crypto winters are periods where people kind of back off and don't do much and sort of wait to see what's the next iteration, what's the next value proposition, use case for crypto. We've had 3 of them. Each of those times, those crypto winters have lasted about 2 to 3 years, and Bitcoin has traded down 80%. Just about every single time. It's been very, very consistent. But what we've seen, very interestingly, within that 6 to 12 months from the bottom of Bitcoin in a crypto winter, institutions have gotten involved. Right? The smart money has come in at a low price and gotten involved in Bitcoin, gotten involved in crypto. And I think this was happening already this time around, way before Bitcoin trades off anywhere near 80%. It was down as much as 40 to 50%. Institutions are getting involved, and that we think is a big difference this time.
So I like in your research note, you say an Amazon-like opportunity for Coinbase. What do you mean by that?
Yeah. So I think the way we've seen Amazon progress over the last, it's been already 25 years, we think is very much the way Coinbase may spend the next 25 years, maybe less, given that everything happens much faster now. So Amazon started off as just an online bookstore, right? It brought it into a bigger marketplace. It added merchandise, it added logistics, it added financing. That was Web 1.0. Then it crossed over to dominate Web 2.0, which is when it began building B2B cloud hosting. As it did that, it was hosting more sellers, it was improving its platform, and adding a whole other, much bigger revenue stream as a service provider. And we know where Amazon has gone, 40% kinds of revenue growth annually if you look at a CAGR over the last 25 years. Very similar in terms of stock returns. Coinbase, similarly, started off as an exchange supporting retail accounts. It's brought in to attract institutions. It's now one of the leaders there. It's adding more products to drive loyalty, more revenue streams, and it's positioning itself for now Web 3.0, the next generation of the internet, which is on the horizon, moving into, as I mentioned, decentralized finance, NFT marketplaces, all things that will be the next generation of the internet. We think Coinbase is there as a leader to support, and therefore could get that kind of growth, kind of stock returns that we saw in Amazon over the last couple of decades.
But that's going to cost money, as you were suggesting. Maybe some investors are a little concerned about that.
Exactly. So we had peak last year, revenue up 5x, margins were north of 50%. This year, expectations are flattish revenue at best. I think they can do a little better. Margins in the 20% range. Still pretty attractive margins, right? But not where they were when we saw the really big numbers in crypto trading last year.
All right, good stuff there, Julie Chariel. Coinbase, COIN is the stock symbol, and that was Julie Chariel. She covers all things fintech for Bloomberg Intelligence. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
All right, let's continue our crypto discussion, and we want to check in with Mike McGlone, because Mike McGlone's a commodity strategist for Bloomberg Intelligence. Quite frankly, everything and anything I know about crypto, I kind of learned from talking to Mike and reading Mike's research, and he's got a new note out here, and it's focusing a little bit on Ethereum. And Mike, I find out, I see myself just quoting Bitcoin, talking about Bitcoin, but there's a lot more out there in crypto. Talk to us about it, Ethereum.
Well, hey, Paul, that's the unique thing about the space. That's the two top ones. It's Bitcoin and Ethereum. And to differentiate the two, Bitcoin is basically becoming global digital collateral in a world going digital. Okay, so it's kind of a trend that's friendly. Ethereum is the building block for fintech. And everything that's financial technologies. For example, NFTs, virtually all NFTs have been made possible by Ethereum, are denominated in Ethereum. And then you look at things like stable coins or crypto dollars. The most widely traded cryptos on the planet now are crypto dollars. They far exceed the volume that's traded in Bitcoin and Ethereum. And almost all crypto dollars were not only made possible by Ethereum, but are traded on Ethereum tokens. So that's basically the foundation for Ethereum. And I'll kind of end with this part, is the key thing that's happening with Ethereum. Soon there'll be a protocol change where it's going to shift its mining status from proof of work to proof of stake, which means the Ethereum will become much more energy efficient, and it'll actually be able to earn income. So key thing for people like you, or equity people, we'll be able to attach discounted cash flow analysis to Ethereum, which is really gaining a lot of attention from equity people.
Do we think of Ethereum as we do Bitcoin, i.e., how big is the market cap, if you will? How do we think about looking at the size of Ethereum?
Sure. We compare market caps, definitely. I mean, the market cap for Ethereum is about around $360 billion or so. It's about half of what Bitcoin's, about $760. It's about 20% of the total. Bitcoin's about 40%. The significance is Bitcoin's percentage of the total market cap of all cryptos has been increasing steadily, most notably the last few years. Bitcoins has actually been declining. So Ethereum's gaining the upper hand. It's just part of the building block. No, that's been a pretty good bull market. It looks like we're more in of a bear market or consolidation phase, but definitely comparable that way. And they're very much differentiated on digital gold versus building block. I think that's the best way to look at this. It's a building block, but it's unique how it does so many things.
Yeah, it's interesting. We were just talking to Julie Shariel, and we were talking about Coinbase, and to me, it seems like, maybe if I don't want to have to make a bet on a particular token, whether it's Bitcoin or Ethereum, I can kind of just buy the exchange and maybe play crypto that way. What do you hear from investors about how they think about really getting some exposure?
Well, that's the key thing to remember is that's why we created the Bloomberg Galaxy Crypto Index almost 4 years ago now. To me, at some point, I fully expect we'll be able to purchase an ETF that tracks the actual index, that tracks the actual coins of this index. So that way, just like the stock market, trying to pick winners can be kind of difficult. So I'll just track the market and let the index, figure out which ones are the winners and losers. And to me, that's where I think it's going. It's just a matter of time. And the SEC has made some baby steps, but to really protect investors should be able to not just speculate in one or two, but be able to buy an index like we can do in equities and bonds and most other assets. And to me, that's just a matter of time. And I think this year is a year of acceleration. So what happened just recently was the SEC just approved an ETF that's a 33 Act for a Bitcoin ETF from Ethereum. And to me, that's part of getting to an actual physical Bitcoin ETF and then to being able to track an actual basket of ETF of these cryptos through an ETF. Now, that's for the masses. For the people who really are in the know, they can do that from different entities, and that's for like high net worth.
High net worth. Yep.
Yeah.
Interesting. So I know when we talked about Bitcoin, really over the last several years, you've dumbed it down for me, which I appreciate, and kind of just saying, hey, limited/declining supply of Bitcoin, presumably more and more use cases. That's a good supply demand that drives prices higher. Is it a similar kind of argument with Ethereum?
Yes, well, Paul, I dumb it down for myself, too. So if I can't explain it, that means I don't understand it. That's the unique thing that happened with Ethereum last year. There was an upgrade, and now by this upgrade, its actual supply is in a pretty significant downward trajectory. Now, you can't really measure it, as I can predict Bitcoin supply out for 10, almost 100 years based on the code. You can't change the code. What Ethereum did, now it actually, when it has high gas fees, those fees actually burn coins. So the supply is actually accelerating downward, and thus with pure, simple rules of economics, supply going down, demand and jobs increasing, price must go up over time. Then there's just the nuances of the day trade in between. It's been fluctuating, who knows, around 3,000 for almost a year now. But overall, if that doesn't change, which I don't think it will, supply continues to decline, demand adoption continues to increase, price should go higher over time. The key issue with Ethereum is there's a lot of competitors. Some people call them Ethereum killers. I just say they're competitors. But it's already the dominant in the space, and it's really gained that dominance, and it's earned it.
So Julie was also mentioning a term that I hadn't heard before. I think it was like a crypto winter or a Bitcoin winter, where these are multi-year moves down in crypto. Do you think we are in one of those?
Oh, yes, I do. But to me, Paul, it's the ebbing tide. I mean, don't fight the Fed. And the stock market is very expensive. And we know recently, if they don't have a reduction in the wealth effect, then they're going to just keep jawboning and they're going to raise rates more. And so you have to narrow down what have been the assets that appreciated the most over the last 5-10 years. Cryptos. And there certainly were massive signs of speculation last year with Doge and Shiba Inu. So we're taking those out. We definitely needed to purge some of that. But to me, it comes down to the building block of the space, and that is, I see Bitcoin coming out ahead on the year. It's actually down less than the NASDAQ. To me, the key stalwarts are Bitcoin, Ethereum, and the proliferation of crypto dollars. Then there's 18,000 other cryptos, and there's just too much supply, too much speculation. That needs to be purged, and that's what we're doing right now. We're purging some of that speculation in all assets, most notably we saw last year. It's just a question of how much further it goes.
All right, crypto dollars, how do I play that? Are there ETF for that?
Well, there's the inside way to play it is you can earn a significant amount of interest on what are called stable coins. I call them crypto dollars because the vast majority track the dollar, just like euro dollars. And those are from things you can just Google and find out. Now the government's starting to crack down on that. But what's the key? It's not so much a play, but virtually every institution on the planet that transacts dollars is going to trick out crypto dollars. A good example is Visa and MasterCard. Instead of being able to to settle their dollars only on weekdays when banks are open globally, they can settle their dollar transactions transactions instantly, anytime in 24/7, virtually no cost, and earn interest. And that's the world is going, where the world's going. That's why I point out the predominant trend in this space that's been almost unstoppable is the increasing market capitalization of crypto dollars, or i.e. stablecoins. They're all dollars, so I call them crypto dollars. And this is where it's really key when people talk about CBDCs, which are central bank digital currencies. I like to say the world, it's already happened. It's gone. The world's gone for the dollar. It's gone for it organically, and that's why they're the most widely traded crypto tokens are crypto dollars.
Good stuff as always. Our special thanks to Bloomberg Intelligence analyst Mike McGlone, bringing us up to speed on all things on that crypto space. Coming up in the program, as mortgage rates rise, borrowers are looking for alternative financing to reduce purchase costs. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 25 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
All right, we're here each and every week at this time tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies and 130 industries worldwide. Mortgage rates are going up. That means buyers are trying to get a little bit more creative about how they finance their houses. And the question is, what does that mean for the mortgage-backed securities market and the folks that trade that stuff? Well, we're joined by Erica Adelberg right now. She is a senior analyst at Bloomberg Intelligence. Erica, again, kind of some interest rates are going up. I'm wondering if people are getting a little bit out over their skis in terms of maybe some of the types of mortgage loans they may be taking. And what does that mean for the MBS market?
I would say that at this point, there isn't necessarily the type of risk of people taking out risky mortgages to purchase homes. The reason for that is because unlike before the great financial crisis of early 2000s, lending standards are far superior. There's been a lot of regulations. The Consumer Finance Protection Bureau has also instituted regulations. So as a result, if anything, some homeowners may be getting priced out of the market from an affordability standpoint.
Right.
Others are perhaps looking for different ways to finance their mortgages, such as adjustable rates to some degree, but much less risky ones. And some are even turning to cash. Yeah, you might wonder how they're finding that cash. In some cases, they're actually getting cash out of their current homes using cash-out refis, but even there, the loan-to-value ratios are generally, at least 80%.
Right, and that's kind of where I want to go, because coming out of the financial crisis, I seem to remember this ability to repay statute. What is that, and is it working?
It seems to be working so far. Of course, it's a little hard to distinguish over the last couple of years, because with the pandemic, a lot of homeowners were granted forbearance, as they lost their jobs and had other financial strains related to the pandemic. So we did have defaults picking up, but now that the economy's back on track, most of those people are back to work, they have been largely repaying their loans, and default rates are actually, from what I've read, historically low. So that was the one exception perhaps to the rule, but there were a lot of safety measures that were put in place to make sure that didn't result in a housing crisis.
Tell us about agency versus non-agency mortgage-backed securities, because I remember, again, kind of these painful memories from back in the financial crisis. It was the non-agency part that kind of really got the market in trouble.
It was indeed. A lot of it was related to the subprime market and even to derivatives in the financial market at large to insure those loans that leveraged up that risk. That was largely the subprime market, and there's significantly less issuance, actually just a trivial part of the mortgage market that's now issued in the subprime sector. There has been, at various times, including last year, a little bit of a pickup in prime jumbo loans. And in fact, the FHFA, the Federal Housing Finance Authority, is, if anything, pushing people a little bit towards that direction as well, again, because they're raising the guarantee rates for jumbo loans as well as second homes. But these are, again, the super prime borrowers. So even if we see a little bit of a jump in issuance in non-agencies related to those fees, I wouldn't expect that to really be a risk for the housing market or for the financial system.
We are certainly in an era right now, and it seems like this is going to be this market for a while, of rising interest rates. How's the MBS market performed going into, again, what seems to be a pretty sustained rising interest rate environment?
Well, the mortgage-backed securities market actually the spreads have been widening. And what that's related to is the fact that the Federal Reserve has been a huge purchaser of mortgage-backed securities to try to support the economy in the wake of this pandemic. And they are now already starting to reduce their footprint. Well, technically, they've stopped purchasing and adding to that portfolio, and they will start allowing runoff probably as soon as May. It may be a little bit later in the spring. And they've even mentioned recently the possibility of selling some of those mortgage-backed securities from their portfolio. So that has also pushed spreads a little bit wider. All in all, it's pushed interest rates up, which is what's pushing up mortgage rates in general, along with the wider spreads for mortgage-backed securities.
Yeah, so is the assumption that when the Fed begins to run off its balance sheet, whether it's in May or some other point, it will be first with mortgage-backed securities as opposed to other securities?
Actually, it's going to be simultaneous.
Okay.
So far, they've set about a $60 billion cap for Treasury runoff, which will be mostly based on maturities, and a $35 billion cap for mortgage-backed securities runoff, although that runoff is going to be based on paydowns, and mortgage-backed securities paydowns with rates as high as they are, they're based mostly on refinancing. Now that fewer mortgages are being refinanced, their paydowns probably won't even reach that $35 billion cap. That's why they've talked now perhaps about additionally selling mortgage-backed securities outright to try to shift that portfolio towards treasuries a little bit faster.
Yep, good stuff there. Erica Adelberg, Bloomberg Intelligence analyst. Coming up on the program, we stay focused on Europe and look at European utilities. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
All right, let's talk transportation here. And this is one of the categories that I really love. Back early in my career, I covered the railroads and trucks for Payne Weber back on equity research. And right now we've got one of the best analysts on the street covering transportation. That's Lee Klaskow, Bloomberg Intelligence transportation analyst. And Lee, I want to focus on the truckers. I know you do a lot of survey work to kind of get a sense of where truck rates are going and truck utilization. What's the latest out there?
Yeah, so it's pretty interesting. So we do a quarterly survey with owner-operators, and these are pretty much mom and pops that own 1 to 5 trucks, and see what they think about where rates are heading and where demand's going. The interesting thing is, like, while we were doing this survey, the spot market declined around 20-25% since the peak. So you had a real quick decline in what we view as unsustainable rates. Despite this backdrop, truckers remain pretty bullish. About 72% of our respondents, and this is a poll that we do with truckstop.com. They're a large load board. And about 72% of the respondents expect load growth over the next 6 months versus 71% in the fourth quarter and the first quarter a year ago. So what that tells us is that truckers remain pretty darn bullish about the outlook. And then when you look at rates, which is even more interesting, about 55% of them expect spot rates, excluding the fuel surcharge, to rise over the next 6 months. That's down slightly from the fourth quarter, which was 59%, but it's still, well over half think that rates are going to go up. And the amount that think that rates are going to go down only increased sequentially by 200 basis points. So, they're not getting overly bearish. And we think this is really being driven by some seasonal trends. Trucking demand tends to increase, which kind of tapers out around August and then, builds back again for, the holiday season.
Hey, Lee, we've all seen it and we've all experienced it at the gas pump, rising gas prices. How are the truckers dealing with that? Can they pass that through?
Yeah, so that's pretty interesting. So, it's going to be really a tale of two cities. So diesel prices since the beginning of the year up around 40%.
Wow.
And and there's been a huge influx of truckers because a lot of people are trying to take advantage of those high and sustainable rates that we were talking about earlier. And they bought equipment that is very expensive. The used equipment market for trucks are up around 30 to 50%. So they came into the market with a really high cost base for their equipment. Now they're facing higher costs for fuel. They offset some of that with fuel surcharges, but it doesn't cover 100%. Loosely speaking, it might cover 65 to 70%. So that's 30% that's not being covered, and that's going to eat into margins. And, while we actually remain extremely bullish on the contractual market, and that's where like companies like Knight Swift or JB Hunt or Werner participate in, and that's because a lot of these people that came into the market with these high prices and high equipment costs, they're probably going to, unfortunately, get forced out of the market because they're just not be able to make enough money.
How about labor, Lee? If I've got 4 or 5 trucks, in my fleet, can I find truckers to actually drive them?
It's tough. Some people argue that there's not a trucking shortage. We would say there's a shortage because there's a retention problem. So not only is it hard to find people to get into the industry because you have to be 21 to have a interstate CDL, because a lot of folks that maybe not go to college that, looking for a trade, they probably find something before they're 21. And there are some new rules that are making it easier for younger people to get in, but it's still a big headwind. But also the turnover rate's pretty high because if you're an over-the-road trucker, meaning that you don't really know where you're going and where your next load is, those people, the work-life balance is really hard because they're never home. And so they get into trucking, they think, I'm going to see the country, it's going to be great. They have this romance vision of what the job is, and they get into it, and they're just like, I'd like to see my kid play softball or basketball. And so they just churn. And also, being a truck driver is extremely fungible, right? So if you work for Trucker A and your manager, kind of pisses you off, you can go to Trucker B and make probably a similar wage, if not a little better, especially in this environment. So there's a lot of turnover.
And I guess it's always been that way. It's a tough job, certainly. Lee, with your research coverage, you cover the whole supply chain, the truckers, the railroads, the ocean-faring vessels that take cargo all over the world. What's your current view of this global supply chain? Are we any closer to getting back to more normalized times?
The good news is that things will normalize. The bad news is not anytime soon. Everyone is still reeling from the dislocations that happened in the market from the pandemic. And right now, the interesting thing is, you look at the Port of LA and Long Beach, they had about over 100 ships just waiting to dock. Normally they might have like 1 or 2.
Wow.
And that got down to, the low 30s, high 20s. But you have to remember, a lot of that has to do with the fact that China's been shut down for a couple of weeks now. And once China reopens, once the COVID-related lockdowns are ended, you're going to have another surge in demand of freight. And that's one of the reasons why we're still relatively bullish on the trucking cycle, because that freight's got to come into the country and it's got to move. And the rails, are trying to improve their fluidity or how quickly they can react to that kind of demand.
All right, that's great stuff. Bloomberg Intelligence analyst Lee Klaskow. We stay focused on Europe now and look at European utilities. For more, we hear from Bloomberg Intelligence analyst Patricio Alvarez. Patricio, we got interest rates going up here. How have the European utilities performed? And kind of how do you think they're going to perform in what looks like we're going to be in a big-time interest rate rise?
The way we see European utilities performing in this higher rate environment is well not new to the markets. I think everyone knows that utilities have that safe haven appeal to them and tend to move in a counter-cyclical way versus yields. So as yields go up, unfortunately, European utility share prices are set to come down. And of course, the companies that have a higher share of regulated earnings, being the gas distributors and power distributors, the ones that are most exposed to this rise in yields.
All right, Patricia, I must warn you, I know just enough to be dangerous when it comes to this electric utility business because I read the book. It's called The Grid. It's kind of the history of the U.S. electrical business in the United States. So I know just a little bit here. My question, though, is this trend to renewables, I'm not sure if it's just a near-term challenge for this industry or if it's a fundamental long-term challenge that this electric utility industry may have a real fundamental difficulty making the transition. How do you think about that?
So that's a very good point. So we are sort of at this pivotal moment, I'd say, especially in Europe, where utilities, I think, are at the forefront of the energy transition. I think they've pivoted to wind and solar much faster than or earlier than U.S. utilities, particularly. So in terms of what this means for the grid, we've seen a lot of expansion targets for capacity for generation, but we still haven't seen a real clear outlook on how this is going to get connected to the grid, as you will point out. Grid parity is still not there, meaning that renewable generation is not competing vis-a-vis traditional generation yet. And the other point is that we have not yet, we don't have clear visibility over the infrastructure growth that we're going to need to connect all this new renewable capacity onto the grid and how this may impact it. I think this is something that we will see evolve over the midterm, perhaps over the next 3 or 4 years. We'll see companies invest heavily in adapting their current networks and current gas transport and transmission lines to this new wave of renewables, but we haven't seen that quite yet.
Yeah, I mean, it sounds from what you're saying that it could be a big capital spending cycle for these European utilities. Yeah. Is that something that investors are okay with? Do they feel comfortable that these companies can generate good returns on this capital investment, or is that a headwind?
I would say that the short answer is it's complicated, and as I said in the beginning, it's maybe select companies that will be able to sort of match their expanding balance sheets with earnings growth. We see that companies European utilities as a whole will invest 95 to 100 billion euros in 2022 and 2023, which is a repeat of 2021. So we see this heavy capital investment increasing by about 20% in 2022 and 2023, and we only see a meager earnings growth of about 5 to 6%. So these means that balance sheets are going to be, indebted and getting more and more indebted, and we will need to see this earnings growth flow through so that the dividends don't get hammered as much. So as you say, investors won't like this as a whole, but there are select opportunities, we believe, within the sector.
Just real quick, we can't talk about utilities without talking about M&A. And when I see industries in fundamental transition, I think, boy, that's kind of one of the supporters for M&A. What's your M&A outlook for this space?
Sure. So again, as you began saying, interest rates are going up. Financial conditions are tightening across the globe, plus that geopolitical risk premium that we're seeing, especially in Europe. So within that scope, we don't see lots of scope or room for large scale M&A. So we don't expect big acquisitions or mergers of equals. But we do see small bolt-on deals still forming part of European utilities' growth strategy, especially in networks, where it's a lot harder to expand organically, given all the permitting hurdles that you have and all the infrastructure involved. We still see M&A as part of their growth outlook, and also for renewable-focused utilities, developers such as Ørsted or RWE. They will still use M&A as part of their business model, which is developing wind and solar projects to later on sell a stake, sort of to crystallize the value and also help fund further growth.
Good stuff there. That's Bloomberg Intelligence analyst Patricio Alvarez. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.